Hello everyone, Chapter 8, Stock Valuation. In this chapter, we're going to show you how to calculate the stock price, how to use the parameters in the dividend discount model, how to use comparables to value stocks, and then I'm going to summarize some common features of common and preferred stocks. Finally, we talk about stock markets. So when you buy a share of stock, you receive cash in two ways. One is dividend. If a company pays dividends, you can receive quarterly dividends from the stocks, but not all companies pay dividends. Then you only have one cash flow, which is by selling the stocks, so the proceeds from selling the stocks. Okay, you can only have two types of cash flow from holding the stock. One, dividends. Two, selling the stocks. Well, it's very similar to the bonds. With the bonds, you have the coupon payments, which is very similar to the dividend payments. But coupon payments are fixed. Dividend payments are not fixed. The selling price of the stock is sort of similar to the cash flow of the terminal face value payback. But face value is fixed, $1,000, or the multiple of $1,000. While the proceeds from selling the stock, there is no guarantee. To calculate the value of the stocks, you just need to calculate the discount value of all these dividends and face values. Okay. Well, the thing is, there are some differences between the debt and equity. By debt, I mean corporate bonds or borrowing from the banks. Okay? While equity means stocks. What are the difference? For the debt, when you purchase the corporate bond, you do not have the ownership of the company. The creditors do not have any voting rights, means the buyers of your corporate bonds or the banks you borrow money, they have no voting rights on your daily activities. Interest is considered a cost of doing business and is tax deductible, means the coupon payment a company paid is considered as expense and can be deducted from the gross profits. Creditors have legal recourse if interest or principal payments are missed. Means if a company missed a payment of either coupon or face value payment, the creditors or the holders of the bonds will sue you and you will go into the bankruptcy process, liquidating all your assets to pay off your creditors. That is why if you borrow too much, excess debt can lead to financial distress and eventually bankruptcy. While with stocks, that is very different. When people buy shares of stocks, they purchase the ownership interest. They have the ownership. Common stockholders can vote for the board of directors and other important issues. If the majority of the stockholders are not happy with the CEO, they can vote for the directors and ask the directors to replace the CEO. So they are very powerful. Dividends are not considered as a cost of doing business because the dividends are considered as the distribution of profits to its owners. Remember, the stockholders are the owners of the business. Therefore, the dividend payments cannot be tax deductible. Means if the company pays dividends to the shareholders, the total dividend payments cannot be deducted from the gross profits. Dividends are not liability of the firm. There is no obligation of the company to pay you any dividends at all. Okay, which means if you do not receive dividends, there's no way you can sue the company, because that is the rights of the company to decide whether to pay dividends or not, or how much. All equity company cannot go bankrupt merely because of debt, since it has no debt. To value the common stock, we start from the 1-period example. Now suppose you are thinking of purchasing the stock of the following company, and you expected to pay a $2 dividends in 1 year. And you also expect you can sell the stock for $14 at that time. If the discount rate or if the required rate of return is 20%, how much are you willing to pay for the stock? Well, all you need to do is, let's calculate the present value of all future cash flows. In this 1-period example, it's very simple. In 1 period, you sell it for $14 and you receive $2 dividends. Both numbers are expected. Divided by 1 plus 20%, $13.33. That is the maximum amount of money you're willing to pay for the stock. Now let's extend the problem to 2 periods. Again, how much are you willing to pay for the stock? Now, in addition to the dividend in 1 year, you expect a dividend of $2.10 in 2 years. And instead of selling it at the end of 1 year, you want to sell it at the end of year 2 with a higher price, $14.70. How much is the stock you are willing to pay? Again, we calculate the present value of all cash flows. The first cash flow is $2 dividend paid in year 1, discounted at 1 plus 20% to the power of 1 year. The second year, we have 2 cash flows. The second dividend, $2.10, plus the selling price of the stock, $14.70. Both of them are discounted at 1 plus 20% to the power of 2 years, while the price is still 13.33 cents. Alright, now I'm going to extend the model to 3 period. So in addition to the dividends you received at the end of year 1 and 2, you are expected to receive a dividend of $2.205 at the end of year 3. And you think you can sell the stock for $15.435 at the end of year 3. How much are you willing to pay? Okay, again, we discount all cash flows. First year, $2, discounted at 1 plus 20%. Second year, second dividend, $2.10, discounted at 1 plus 20% squared. Plus, the last year you receive the last dividend payment, plus the money you get from selling the stock, $15,000, discounted at 1 plus 20% to the power of 3 years. Again, the stock price is 13.33 cents. Okay. Well, I can continue this example forever, right? But to save time, let's actually develop a general model to calculate the stocks if you want to hold the stock for multiple periods, well, or indefinitely, right? So we can extend our previous examples to indefinite periods. You could continue to push back the years in which you will sell the stock. So you will find if you never sell the stocks, you postpone selling the stock to forever, then all the cash flows you are going to receive is the dividend, right? If you hold the stock forever, never sell it. All you need to do is you need to calculate the discounted value of all future dividends. You don't have to worry about selling price anymore if you hold the stock forever. So the price of the stock is going to be each period's dividend divided by the discount rate. Okay? All right. So how can we estimate all future dividend payments? To simplify the model, we have to make some assumptions. The first one is case 1, 0 growth. Okay, so the first one, we assume there will be no growth in the dividends each year you receive the same amount of dividends. Okay? If that is the case, each year D1, D2, D3 until D forever are just the same number, then this is our application of the perpetuity. Remember in the previous chapter when we talk about the perpetuity, right? A constant cash flow paying in the future forever, right? So if you still remember the formula for perpetuity, the zero growth stock value is going to be dividend, the constant dividend divided by R. For example, if a stock is expected to pay 50 cents dividends each quarter forever, the required rate of return is 10%. What is the stock price? Okay. Well, the stock price will be, the constant dividend will be 50 cents forever divided by the R. Here, you will receive $50, 50 cents each quarter, but the interest rate here is annualized number, which means we need to calculate the quarterly rate, which is 10% divided by 4. So 10% divided by 4, we found the quarterly R. So quarterly dividend payment, 50 cents, divided by quarterly discount rate, $20. That is the amount of money you're willing to pay for the stock. Okay, so the zero growth case is actually our preferred stocks. For preferred stocks, you have a fixed dividend payments. That is how you evaluate the price of the preferred stocks. Case 2, constant growth. Okay, in our second case, we are going to have a different assumption. Instead of assuming a zero growth rate for the dividends, we assume the dividend will grow at a constant rate, G. After all, most of the people want to buy a stock which has some growth potential, right? Okay. So dividend 1 is going to be dividend 0 times 1 plus G. Dividend 2 will be dividend 1 times 1 plus G. So each period, the dividend will grow by 1 plus G. If we rewrite all the future dividends in terms of D0, okay? So D1 equals D0 times 1 plus G. D2 equals D0 times 1 plus G squared, so on and so forth. Okay. Well, then the future cash flow grow at a constant rate forever. It means this is the application of the growing perpetuity. If you still remember the growing perpetuity, right? That is P0 equals the next period payment, D1 divided by R minus G. Okay? Recall our growing perpetuity formula. P equals the next period payment divided by R minus the growth rate. So let's take a look at the following example. Big D just paid a dividend of 50 cents. Just paid means this 50 cents is D0. You just receive it. Growth rate is 2% a year. Rate of return or the discount rate, 15%. How much are you willing to pay for the stock, or how much the stock should be selling for? Plug in our formula. D1. We know 50 cents is D0, so D1 is 50 cents times 1 plus 2% increase rate, or the growth rate, divided by R, 15% minus growth rate, 2%. So the stock should be trading at $3.92. Okay. In our third case, which is the hardest one, we assume a different growth rate because this is more realistic. For a lot of the companies, at the beginning years, when they are young and small, the growth rate is really high. After a period of high growth, they reach the maturity. becomes a big company, then the growth rate will approach to a lower but more stable number. Okay, so in this case, we are going to assume a company will have different growth rate in different stage. Okay, we look at the example here. The textbook introduced a very complicated formula to calculate the differential growth model. I don't really want you to do that because nobody can remember that complicated formula for one reason. Another one is if you know the intuition behind this differential growth model, there's no need to remember the formula. You can always draw the timeline and solve the problem very easily. Let me show you how. A common stock just paid a dividend of $2. Okay, just paid. That is your clue. $2 is the dividend 0. The dividend is going to grow at 8% for 3 years. Fast growing period for 3 years. Then it will grow at a lower rate forever. How much is the stock worth? The discount rate is 12%. Okay, so all we need to do is to draw the timeline. You just received $2 dividends. So 2 is right here at time 0. But since you already received the cash flow, it doesn't count in our calculation. In the first period, the $2 dividend will grow at 8%. Second year, another 8% growth. Third year, another 8% growth is reflected in the power term. Okay? Starting from year 4, the company will be growing at 4% forever and ever. Okay? So starting at year 4, we can start using our constant growth model. Okay? So all we need to do is we have to individually calculate the fast growth dividend period. So in year 1, $2 times 1 plus 8%, $2.16. Year 2, $2.33. Year 3, this item, $2.52. Okay, so what happens in year 4? In year 4, let's first calculate D4, dividend 4. Dividend 4 will be dividend 3, right here, times 1 plus 4%, okay, which is $2.62, okay. Using the $2.62 divided by the difference of the required rates of return, 12%, minus the growth rate, 4%, 8%, we can calculate P3, which is $32.75. Because remember our constant growth model, P0 equals D1 divided by R minus G. But if here, instead of D1, we're using D4, then we're actually calculating P3, which is $32.75. Okay? Alright, so to calculate the P0, we need to discount the first dividend at 1 plus 12%, second dividend, 1 plus 12% squared, third dividends, plus P3, which is $32.75 together, divided by or discounted at 1 plus 12% to the power of 3 years. You add all of the items up. The price of the stock you are willing to pay is $28.89. Okay? As long as you know how to draw the timeline, and at some point you can start using our formula in the second case, constant growth model, right? You can start using that model and calculate the price. Then all you need to do is manually calculate the present value of all cash flows and then add them up. Estimates of parameters. You might want to ask me, where does the growth rate G come from? What is the growth rate? How do you calculate that? Okay, we have one formula for the growth rate, which is the retention ratio times return on equity. Okay, ROE, return on equity, or return on retained earnings. What is retention ratio? Let me give you an example. Suppose at the end of the year, the company is making $5 earnings per share, okay, per share. Earnings is $5. The manager can decide, well, this $5, we can pay all $5 out as dividends to the shareholders. That is one option. The second option is we can keep all $5 earnings within the company and invest in some new projects. That's the second option. A third option is somewhere in between. Maybe we can pay out a portion of the $5 as dividends and keep a portion of it to invest in new projects within the company, right? Okay, so in case the manager decide we're going to pay out, say, $2 as dividend, then the payout ratio will be the percentage of the earnings that paid out as dividends. In this case, $2 divided by $5, 40%. Then the remaining one will be $3, right? So the plowback ratio or the retention ratio is going to be $3 divided by $5 earnings, 60%, which is the fraction of earnings returned by the firm. As you can see, the plowback ratio and the payout ratio always sum up to 1, because for the $5 earnings, you either pay it out as dividends or you keep it within the firm. There is no third option, right? So the payout ratio plus the retention ratio always equals to 1. So where does the R come from? Well, the R, or the discount rate, can be broken into two parts. One is the dividend yield. Another is the growth rate, or the capital gains. In practice, there are a lot of estimation errors involved in estimating R. Well, so the best thing we can do is we start from the formula, okay? Knowing we will have a lot of estimation errors, but that is the best thing we can do from this model. This is our baseline model. P0 equals D1 divided by R minus G. Okay, so R, if we rearrange the formula and put R to the left-hand side, okay, and put P in the right-hand side, what we have is going to be R equals D1 divided by P0 plus G. Those are the two parts we are talking about. D1 divided by P0 is the dividend yield, or the return comes from the dividends. The second part is the growth rate, or the return coming from the appreciation of the stock. Here is an example. The company is expected to pay the first year dividend of $3. So this is D1. Growth rate 8%. Initial stock price $75. So this is P0. The expected rate of return is, plugging all the numbers in this formula, the dividend yield is going to be $3 dividend D1 divided by P0, $75, plus the growth rate 8%. Basically, the dividend yield is 4%, so the total return of the stock is 12%. 4% comes from dividend yield, 8% coming from the stock price appreciation. Okay, another example. Now suppose we have a firm, stock is selling for $10.50, just paid $1 dividend, so this is D0. Growth rate 5%. What is the required return? So the first question is, let's calculate the dividend yield. What is the dividend yield? And then we calculate the capital gains yield. Okay, so the return will be, according to our formula, D1 divided by P0 plus the growth rate, 5%, right? So D1 is $1 just paid, D0 times 1 plus 5%, divided by P0, 1050, plus the growth rate, 15%. Dividend yield, let's decompose the R, is the first part, the dividend divided by price, 10%. The second part, capital gains, which is the 5% growth rate. So another common way to calculate the stock price is to use the multiples. One famous multiple is the P/E ratio. What you can do is you multiply a benchmark P/E ratio by earnings per share to get the stock price. The formula goes like this: benchmark P/E ratio times earnings per share. You get the price. So the benchmark P/E ratio is often an industry average or the company's own historical average number. The EPS is the reported earning per shares number. Well, the beauty of using multiples is the benchmark P/E ratio is reported by all major newspapers. The earnings per shares are reported by the firms each quarter, so those numbers are readily available. All you need to do is multiply them. Sometimes people do not use P/E ratio, they use the P sales ratio or the price sales ratio. Well, it's very similar, the formula. Okay, all right. So the P/E ratio equals price per share divided by the earnings per share. For Wall Street Journal, they use the last 4 quarters earnings. Each year, you will have 4 earnings numbers. Each quarter, the company will report one. Here is the example. A company had earnings per share $3 over the past year. The industry average P/E ratio 12. How do you expect the stock price? You will expect the stock price to be 12 P/E ratio times $3 per share, $36. So it's very easy. 3 and 12 are the numbers reported to you. All you need to do is to multiply them and to get an expected stock price. To summarize, to value the stock, the general case is you have to calculate present value of all future dividends. But the problem is there is no way to estimate individual dividends in each period. So the general model is 100% accurate, but in reality, there is no way you can physically estimate each dividends into the future. Then we simplify the model a little bit. We calculate a constant growth model. We assume the dividend will grow at a constant rate, G. So the price of the stock of the constant growth model will be D1 divided by R minus G. Then we introduce the two-stage model. In the early stage, the company is growing at a faster rate, G1. Second stage, G, which is G2, which is constant, forever, stable growth rate. I did not introduce this formula in our lecture notes because I want you to draw the timeline to solve the problem instead of remember this very complicated formula. The next way to value the stock is to use the multiples. P/E ratio most often is used, so the price will be the benchmark P/E ratio times earnings per share. Or sometimes you can use the sales number, the benchmark P sales ratio times the sales per share. To calculate the required rates of return, we still use the constant dividend growth model. We rearrange the model to calculate R, which is dividend yield plus the stock appreciation or the constant growth rate. Here are some features of the common stocks. When you purchase 1 share of common stock, you're purchasing 1 voting rights. Means shareholders can elect directors, while the directors will hire or fire managers. For example, if you are not very happy with the current manager, say the CFO, CEO, you can tell the directors making sure the directors will hire another CEO, CFO. If the directors refuse to do so, you can select different directors in the board. So that is why voting right is very important. The shareholders control the corporation through the right to select the directors. The directors are elected each year at the annual meeting. One share, one vote. Well, sometimes we hear the word proxy voting. Well, for example, if you purchase 5 shares of Apple, it's not really too many shares. You wouldn't go to the annual meeting of Apple Corporation to vote. It's not even worth the trip, right? What you can do is some voters would like to collect your voting rights, your 5 shares of voting rights. Okay? You can give this proxy vote or give your vote to another shareholder, and another shareholder will vote for you. Okay? Much of the voting in large public corporations is actually done by proxy because a lot of the small shareholders, they don't really want to go to the annual meeting to vote their small shares, right? But if you have one voter who is collecting all the voting powers of many small voters, you can pull them together. Then it will be worth the trip to go to the meeting and vote, to cast a vote. Other rights of the common stocks. Well, of course, you can share proportionally in the dividends, right? Each quarter you can receive dividends according to how many shares you have. Well, in terms of bankruptcy and liquidation, whatever left in the company, you are proportionally you can proportionally claim your assets after the liquidation. Also, you can proportionally purchase the new stocks, which is called pre-exemptive rights. Means if the company want to sell new shares, they will ask you first whether you want to purchase the new share or not. If you say yes, they will sell the shares to you. If you say no, then they will sell the shares to someone else. The reason there is preemptive rights is, for example, there are 200 shares outstanding for a stock. You purchased 200 of them, so you have 100% control of the company, right? If the company wants to issue another 200 shares and sell it to someone else, then all of a sudden there are 400 shares, and you found yourself in the situation of only 50% ownership. You will not be happy, right? So the company will ask you first whether you want to purchase the additional 200 shares. If you want to remain 100% control, you will buy the new 200 shares. You have the priority to do that. Here are some common characteristics of dividends. First of all, dividends are not a liability of the firm until dividend is declared by the board. So at the end of each quarter, the company will declare how much dividend they want to pay. If they declare we're going to pay $2 per share dividends, then it becomes a liability of the firm. After the declaration, the company has to pay the declared dividends to the shareholders. But dividends are not a liability if the company decides not to pay it. If the company announced we are not going to pay any dividends at all because we are not really doing well in the current market condition, then you do not receive any dividends. Well, consequently, a firm can never go to bankrupt for not declaring dividends. In fact, many companies do not even pay any dividends at all. So some features of the preferred stocks. Well, Preferred stocks generally do not have any voting rights, which means they are going to receive some priorities in terms of dividends. Okay. The preferred stocks dividends have higher priority over the common stock dividends. In terms of liquidation, bankruptcy, or declare of dividends, if the company do not have enough money to pay both preferred stocks dividends and the common stock dividends, they will give the priority to the preferred stock dividends. Okay. So the stated dividends must be paid before any dividends can be paid to common stockholders. While the preferred stock dividends are not a liability of the firm, while the preferred stock dividends can be deferred indefinitely, which means if the company is not really doing well, they don't really have to pay the promised preferred stock dividends. They can defer it indefinitely. Most preferred stock dividends are cumulative, means yes, you can defer it. But if you miss any preferred stock dividends, you have to pay them back cumulatively before any common stock dividends can be paid. For example, if the company skipped 2 preferred stock dividend payments, it's okay. In the third quarter, if you want to pay dividends to common stockholders, you have to make it up to the preferred stockholders by paying back the missed cumulative preferred stock dividends. Then you can announce dividends to the common stockholders.